The highly anticipated IPO of Snap Inc., parent company of Snapchat, has put the spotlight on its founders. Not just because they're young, rich tech entrepreneurs, but because they are being labeled by some analysts as total control freaks. When Snap goes public on March 2nd, 26-year-old Chief Executive Evan Spiegel and 28-year-old Chief Technology Officer Bobby Murphy will retain more than 90% of the voting power in the company. And in an extremely rare move, Snap is not offering any voting rights to investors who buy Class A shares in the company. By contrast, Class B shareholders will be entitled to 1 vote per share, and Class C shareholders, like Spiegel and Murphy, will be entitled to 10 votes per share. The structure will give the 2 millennial co-founders who created the disappearing photo app in a Stanford dorm room the power to make key decisions, like the makeup of Snap's board, the approval of mergers or acquisitions, and the sale of assets.
We approach innovation really differently at Snap. It's not a, throw things at the wall and see what sticks kind of company. Every time I'm talking to someone that uses our service, they always say, I just can't wait to see what's next.
Snap aims to raise $3 billion in its IPO, which could put the company's valuation at as much as $22 billion. While Snap is one of the only companies to ever go public with non-voting stock, it's not unusual for tech executives to retain control when taking their companies public by creating multiple voting classes. Google set the trend in 2004 when it IPO'd with a dual-class structure that gave its co-founders, top executives, and directors 10 times the voting power of regular investors. 10 votes per Class B share compared to 1 vote per Class A share. Companies like Facebook, Groupon, Zynga, Fitbit, and LinkedIn followed suit, using multi-class share structures to issue so-called super voting shares for a small group of insiders and early investors. Many tech executives prefer to keep control of their companies so that they can innovate and grow without risking a revolt by shareholders. Facebook founder Mark Zuckerberg controls roughly 54% of the social media giant's voting rights, according to a June 2016 filing. Google co-founders Sergey Brin and Larry Page currently control more than 52% of parent company Alphabet's voting power, according to an April filing. Both companies have been a goldmine for investors, providing strong returns since their initial public offerings. But it's extremely rare to see founders retain control of more than 90% of a company after taking it public, like Spiegel and Murphy will do. And there are major risks to buying tech companies with outsized voting power. Zynga, for example, gave founder Mark Pincus 70 votes for each of his shares when the company went public in 2011. But the social gaming company has been mired by management shakeups and a declining user base. Shares are worth just 1/3 of what they were on the day of the company's IPO. And Groupon, which gave its founders 150 times the voting power of regular shareholders, has also struggled. Shares are now worth just 1/6 of what they were on the day of Groupon's IPO. In its prospectus, Snap says it cannot predict whether the company's share structure will result in a lower trading price, greater fluctuations, or adverse publicity. That means investors buying shares of Snap will be buying into the vision and decisions of Snap's young co-founder.